In trading, diversification is really the only form of free lunch that we can possibly get. If you manage to combine the right form of strategies together and spread your risk across these strategies, you can end up with not only better returns, but also lower drawdowns. However, if you do this incorrectly or improperly, you can just be essentially multiplying the same risk factor and end up with a portfolio which is just one big levered position in one very similar strategy, and then end up with probably more drawdowns, higher drawdown sensitivity, and potentially even lower returns. So when actually building a good portfolio, what do you have to look out for? And in this video, we're going to discuss a few different factors which you should consider when building a portfolio of trading strategies. So the first one to discuss is obviously the most straightforward, which is looking at a combination of long and short strategies. So this is a great example of NASDAQ, and as you can see, since the Liberation Day tariff announcements, we've been in a pretty strong bull market where it's just been ripping to the upside. However, there's also periods where you can indeed have corrections, and where you can have even some pretty major bearish markets for over a year. So what do we do during these periods? How do we also ensure that we still make money even if the market is going down? And this is really where using algorithmic trading strategies can be amazing versus more just buying ETFs, because you're able to make money regardless of the market is going up, down, or sideways based on building a portfolio of bidirectional strategies. So the first thing we have to look out for is when building a portfolio, ideally you don't want to be only long. You want a mix of long and short, or if you're only long, you want to go to cash during bad times. You don't want to always be in the market in a long basis. So you need to be able to survive bearish markets when constructing your portfolio. Another really important factor here in the second perspective is what type of markets are you actually trading? If you're only trading, for instance, US equities, and the US market has a bit of a correction, like we could see here, for instance, in 2022, then you could be very much overexposed to the US market. And in doing so, you won't necessarily have the smoothest equity curve than you possibly could. If you were to look at a different asset, let's for instance look at Japanese markets, we can see that during the 2022 period it was a bit choppier, but still the price action was quite a bit different. So had you been trading Japanese markets, maybe you would have had a different result. Same thing, we can go look at Bitcoin. Bitcoin usually follows US equity markets, so we had a similar pattern here, but the point holds that effectively you can always pick something which is generally having a more favorable type of market condition to build strategies around. So the second thing is you never want to have too much exposure to any one given market. So number one is long and short. Number two is various assets in various markets. The third one here is going to be hold time. When developing a variety of different strategies, the beautiful thing about algorithmic trading is you can have some bots that hold for a day, and you can have some bots that hold for 2 seconds. And depending on the hold time, your actual strategy could be very diversified in the broader market. To give you a great example, let's say that you're trading an opening range breakout like our ultimate time bomb on US 30, which just trades the volatility at the open. Even if the market is going up, down, or sideways more broadly during the day, as long as you have that spike at the open, you can make money. And that means that it's kind of a different condition. So you're able to still capitalize on a different type of market or different types of market because you have a really short hold time for this. Whereas let's say you're trading our longbow fund manager, this would require, generally speaking, something to be going up in order to make money. And that's why it generally gets out of the market in the event that things are not going up. So by kind of varying your hold time, you get to take advantage of almost different types of market behavior within a broader regime, which adds a whole other layer of diversification. So kind of coming back to it here, we have the first one being you want to trade long and short, the second one being different markets, and the third one is you want different hold times. You don't want to just hold everything for a day, you don't want to just hold everything for 2 seconds, because if you have a very choppy intraday price action, you're holding everything for 2 seconds, like we sometimes with our rocket bot here, sometimes we hold everything for just a few seconds actually. Like you can see here, we hold some for 3 seconds or 6 seconds or 8 seconds. Like if you do this for everything and you happen to enter a high spread environment, then maybe it won't do as well. So that's why really varying that time is also super important. And now another really good factor to discuss is trend following versus mean reversion. And essentially that comes down to, along with long and short, some bots do better when we have these long trending periods. Think breakout bots or essentially trend following, so like you're buying momentum that continues for the entire day. Whereas some bots do better when markets are moving sideways. So this could be like a grid bot. Grid bots love sideways price action. That's why they do so well on the Aussie dollar, New Zealand dollar. So if you're really building the ideal portfolio, ideally you want something that has a mean reversion aspect to it, along with more of a trend following aspect, to kind of give yourself this additional level of diversification. And then finally here, we can look at different types of triggers. And the trigger is to why you're entering the market. This could be a break of a certain high, this can be a fundamental reason, it can be indicator based. But ultimately, if you vary your triggers, then you might add another layer of diversification, because all of a sudden, if you have something which is support and resistance based, then if support and resistance is being particularly robust in a given market environment, those bots will do super well. However, if you have something which is more based on, let's say, an RSI or more of an oscillator, maybe the certain bots are going to do well during a different period. So if you vary the trigger, then you're going to have also another way of adding further diversification. And what this looks like is, here you can see we have plenty of different strategies together, and then we kind of combine them in this one portfolio of 3. And this involves a couple of like long trend following bots, a couple opening range breakouts, and a couple scalpers. And in doing so, we're getting something here which gives us a beautiful equity curve with roughly a 100% annual return with only a 9.7% drawdown. So that gives a truly magnificent equity curve because we have these different stacked layers of diversification. So guys, next time when you think portfolio management and building a portfolio, always think, how do I add as many of these layers of diversification as possible? Because that will ultimately give you a portfolio which is more robust across market regimes. Leave me a comment if you have any questions, and I look forward to hearing from you. Cheers.